Attention all traders and investors. Get ready to revolutionize your trading game with the most powerful and intriguing candlestick patterns out there. In this exciting video, we are going to take you on a thrilling journey through 5 extraordinary candlestick patterns that have the potential to skyrocket your trading profits. Brace yourself as we unlock the hidden gems of the market and reveal the patterns that can shape your trading destiny. Subscribe now and join us as we explore the fascinating world of candlestick patterns, where knowledge is power and trading success is within your reach. The downside Tasuki Gap is a popular candlestick pattern used by traders to identify the continuation of a downtrend. The pattern consists of 3 candles, with the first two being red or black candles that continue the current downtrend. The second candle opens below the previous candle's close, creating a gap. The third candle is a white or green candle that opens below the second candle's low but closes within the gap between the first two candles. This indicates that there is buying pressure, but it is not strong enough to break the downtrend. Traders often use the downside Tasuki Gap to confirm a bearish trend continuation and enter short positions. The falling window, also known as the falling gap, is a bearish candlestick pattern that signals a potential continuation of a downtrend. This pattern is characterized by 2 consecutive red candles with a gap between them, where the opening price of the second candle is lower than the closing price of the previous candle. This creates a window or gap on the chart that suggests a strong shift in market sentiment towards selling. Traders often use the falling window as a signal to enter short positions or to add to their existing short positions. The gap represents a sudden shift in market sentiment towards bearishness, and the continuation of the downtrend may continue until a support level is reached. The bullish high wave candlestick pattern is a signal of potential trend reversal in the market. It is formed when the market experiences high volatility, resulting in a long upper and lower shadow with a small body in the middle. This pattern indicates that the market has experienced significant buying and selling pressure, but neither side has been able to gain control. Traders look for a bullish high wave pattern when the market is in a downtrend. The pattern signifies that the sellers have exhausted their supply and buyers are taking control of the market. When a bullish high wave pattern is confirmed, traders enter a long position, anticipating a potential trend reversal. The bearish high wave candlestick pattern is a reversal pattern that can be identified when the market is in an uptrend. This pattern suggests a potential trend reversal in the opposite direction. The pattern is formed by a long upper shadow with a small real body and a long lower shadow. The small real body indicates that buyers and sellers were equally matched, but the long upper shadow shows that the bears took control during the session and pushed the price down from the high. The long lower shadow shows that the bulls tried to push the price up from the low, but they were unable to sustain the upward momentum. Traders use this pattern to indicate a potential selling opportunity. The morning Doji star candlestick pattern is a bullish reversal pattern that consists of 3 candlesticks. The first candlestick is a long red or black candle, followed by a Doji candlestick. The Doji candlestick opens and closes at the same level, creating a small or non-existent real body. The final candlestick is a long white or green candle, which opens above the Doji's high and closes near the first candlestick's midpoint. The pattern suggests that the bears are losing momentum, and the bulls are gaining control, resulting in a potential reversal in the trend. Traders use this pattern to identify buying opportunities after a prolonged downtrend.